are here. All right, on really horrible days, I come out and tell you not to panic. If we get a decent couple-day rally like this one, I got to urge some caution so your enthusiasm doesn't get too out of control. We're up too much from just 4 straight days. Now, you know I think this move makes some sense, given that it seems as though the Europeans are finally getting their act together and doing something to solve the darn problem that's caused all this morass. But we always listen to contrary views here on Mad Money. It's always been our way for 7 years now, especially when the contrarian has a track record of being right and has been sizzling with the hot hand. That's why tonight we're going off the charts with the assistance of Richard Ross. Yeah, remember? Global technical strategist at Arabac Grayson, in addition to being the guy who told us a week ago that we were on the verge of a gigantic breakdown in the S&P and that gold would get clobbered. Ross was dead right immediately, even as though the market has turned around this week. Though the stunning declines from the high of this day today, I found very disturbing. It was just a collapse from 300 up 90 in a blink of an eye. I think it's important to see what he's saying right now, because Ross, for one, does not believe that this rally will last. The technicals to him show that things are broken. They indicate that we're very much in bear market mode. So it's best not to get your hopes up too much. I like tempering people's enthusiasm, especially after today's stunning peak-to-trough reversal on a negative tidbit about the proposed Greek bailout. So Ross's view is one you got to hear. First, let's check out his read of the daily chart of the S&P 500. Remember, this includes, since he spoke last week, includes this rally. He's not, he's up to date. This is commonly the most it's the most used benchmark for the broader market. Even with this rally, Ross is still pretty skeptical about the S&P. Sure, he thinks that it now has a nice base of support. Hey, that's nice. That's a change, okay? A temporary floor around 1,120 in the S&P, and it could possibly go as high as 1,210 or 1,220. Hey, we'll take that, right? I mean, those of us who think that things are more constructive now than a week ago. However, there are plenty of reasons why he believes the rally won't last. The index has been stuck under its 50-day moving average for over 2 months, all right? So we can see the 50-day moving average. That's this line, okay? It's stuck there for a very long time. That is extremely negative for people who watch these charts. This line keep going down. It's still underneath the key short-term measure of its trajectory. That is a classic bearish sign. Plus, over the last month and a half, the S&P has made a double-top pattern, okay? We see that, this, we had that. You saw that happen. We got another one. That's around 1220. That's a very important negative move. This double-top formation is what's known as a bearish continuation pattern, meaning it indicates the S&P 500 is ready to resume its long walk lower. Ultimately, Ross believes that the S&P will break down below its floor of 1,120, and then we could have another 100 points of downside. Well, we certainly want to try to avoid that if it happens, right? Now, take a look at the S&P's weekly chart, okay, which to Ross is another extremely ugly picture. After breaking down from a dreaded head and shoulders pattern from August, one of the most consistently accurate technical patterns out there has nothing to do with shampoo, which, by the way, I now use because they have this cool shampoo for guys in my Hirsute Challenge position. Everything to do with things falling apart because it forecasts a huge decline. That's what his head and shoulders does. Ross thinks the S&P still has more room to fall. And last week, which is the second to last candlestick on this chart, use this as a candle. These are candlesticks. The action was particularly sinister, creating a couple of negative, if completely, frankly, esoteric patterns. There's the bearish engulfing pattern, which happens when one big candlestick totally eclipses the week before. All right? Boom, boom. Okay? This is typically a sign that more bad things are on our way. Yeah, this pattern is really awful, I got to admit. Even from my trading days, I recognize that. It happened last week, where the body of the candle, which indicates the opening and closing price, totally engulfs all the action from the previous week. Yeah, this is, okay, well, look, it is what it is. When you put it all together here, Ross believes that the S&P 500 could fall to 1,072 at a minimum, and then 1,008 as this downside target. That would be, guys, that would be a disaster for the stock market. It would get back, well, a huge part of the gain that we've had, okay? These prices come from Fibonacci ratios, an important series of numbers discovered by Leonardo Fibonacci. He's a medieval Italian mathematician. Ross believes the S&P will fall to 1,008 because it would represent a 61.8% retracement of the rally from the generational lows in March of 2009. Remember, these are patterns. He sees it over and over again, so we actually just say, okay, listen, every time we see that pattern, you get pounded, all right? There is some good news here, though. Even though Ross expects the S&P to get pounded in October, when that happens, he is saying this is going to create an incredible buying opportunity. So the hope here is that once we get down there, the bear market will end. He's not forecasting endless declines from here to eternity. Important comeback movie for the chairman of the board. Not such a good prognosis for a bear market. Eventually, he says there'll be a bottom. And that's when it will make sense to buy, and not ahead of that. Remember, this is what Ross thinks, not necessarily what I think. How about gold? All right. But he nailed this one. We had the worst decline in years and years and years. He predicted a breakdown in the precious metal that was perfect. We got exactly what he said. Horrific. Just horrific. So what's he say now in daily chart? No, nothing good. I would have thought he would have seen something here since the last week after the rally today, but no, not at all. Ross thinks gold should be sold into that rally today, as we're seeing a speculative unwinding of epic proportions. Check out the relative strength indicator, okay, at the bottom. This directional momentum indicator turned negative at the top, and it did a terrific job of forecasting the recent decline. So he's looking at the RSI, and the RSI has gotten even more negative, creating a fresh sell signal after today. If Ross is right, and based on the last big sell-off of gold back in 2008, it fell 33%. He's using a downside target of $1,325, $1,325. But only if the shiny stuff crashes towards 200-day moving average, which right now is at $1,527. Remember, I don't like that. It means that if it goes down a lot, it will continue to go. If it does go down a lot, then it can bounce. That's not the way I like to think. Gold rallied hard today, but just like with the S&P 500, Ross is unmoved from his negativity. The bottom line, we always pay attention to the charts, especially when a smart chartist like Richard Ross, who's been right a lot lately, has a divergent view from ours. Ross thinks the S&P 500 has a lot of more room to fall, and he also thinks gold does. Based on the fundamentals, I think he's too downbeat on both the S&P and on the precious metal, which I urge you actually to buy on any pullback, unlike he, who would say sell it. When it comes to immediate track record, though, you got to give Ross his due, even if the facts might be changing more positively in Europe, which, alas, is the fundamental cause behind much of the chart damage that Ross is basing his views on. Let's go to Roger in Michigan, please. Roger.
Hey, Jim, this is Roger in Kalamazoo.